Now, guys, I ran recently across an advice column over on Market Watch, which described a couple that retired 6 years ago. In January of last year, they had $500,000. By December, they had lost 20% of that, $100,000. They called their advisor to ask why. And during that meeting, they were told they could lose another 100 grand by the end of the year. So the reader's question was, should I stay with this advisor or should I seek greener pastures? What do you think? What would you say? And let's really pinpoint what went wrong here.
It probably, I think, is in a lot of different ways, is not having a good plan in place from the get-go. And it sounds like poor communications. But if you think about that, think of how long it took that couple to save that first $100,000. And then in a year's time, it'd be wiped out, knowing that they could also lose another $100,000. So a big part of it is when you're looking at when is it time to switch financial advisors, it comes down to making sure that you are working with somebody who specializes in the area of what you're trying to focus on. You know, the challenge about these individuals that, recently retired is they don't have that luxury of time to make up for losses in the early years. So, those losses really hurt. And then in addition to that, if the advisor is doing what's called a pro rata withdrawal, meaning he's just selling off a portion of each investment every month to come up with their monthly income needs, they're selling investments at a loss. They're negative compounding the account. They're accelerating their risk of outliving their money. And all of a sudden, they could be in a situation where they never get it back versus, somebody who, again, using the example of my son at the age of 19, who also is saving and growing wealth for the future. In this example, he might have lost 20% in his investments last year, but since he doesn't need it and he's putting money into his account, it's a buying opportunity. So those losses really, really do hurt for people. Chaz, when you're looking at it and they're talking to people and you run into these type of situations where people come into the office and share that with you, what are you saying?
Yeah, I agree. I don't think it makes sense to fire your advisor just solely because of performance. Because I'll be the first one to tell clients that that's generally not how I would describe my wealth when it comes to financial planning, is being able to consistently every single year outpace the market or completely protect your account from any sort of loss. And I think investors get that. Retirees get that. Yeah, if you're putting money into the stock market, there is going to be a measure of risk. Where I think you should consider firing your advisor or looking for another one is when your philosophy or your methodology as it pertains to your money, what's important to you, the principles that you stand for about your money are either not being taken into consideration or they start to divulge or divide between what you and your advisor think success is. And so that's why it's so important when you're going through the hiring process of a financial advisor. I mean, there's 750,000 financial advisors out there. Every one of them has probably their own core competencies and they have their strengths and weaknesses. But it's important for investors to kind of know, in my opinion, what the investment advisor stands for. And you should be able, as an investor, to articulate that. You may not be an expert, but you should know what the advisor stands for. For instance, clients will ask us, okay, so I'm going to pose that question back to you. What do you stand for? Well, one of the principles that I stand for when it comes to investment management is fees matter. So it's important that if you're paying a fee for something, you know what you're getting in terms of value. Mm-hmm. The other principle that I stand for is, like we talked about earlier, diversification, and the structure is what's going to determine your performance, not necessarily the individual holdings. So last year is a great example. If depending on how much stock and bond you owned, it probably didn't matter much, but do you have the alternative investments in place? Things like your annuities that are principally guaranteed. So how did we structure your portfolio? And more importantly, why did we structure it that way? That gives kind of a tips your hat to the fiduciary standard, which we abide by. And then also the other principle that we stand for is, what are the real rates of return? Not just the average, meaning did your advisor or do your potential advisor show you 10-year average rates of return, or they're showing you the actual dollar amount that your investments would have grown to? or have grown to over time when you're looking at those decisions. So there's a lot to unpack there about when to hire, when to fire. Ultimately, I don't think it's based solely on performance because, like we talked about, if we had that appropriate mix of assets and we had our first 10 or 15 years guaranteed with guaranteed sources of money and our long-term assets were down 20%, generally bear markets don't last longer than 15 to 24 months, somewhere around there. Very few times is a stock and bond markets down together. So I think you might be a little bit more comfortable knowing that your variable assets were down 20%. Is it the whole portfolio? There's a lot there, but generally the investment philosophy, if we start to separate there, it's probably a good idea to look for somebody else.
Yeah, so when you're taking a look at when is it time to switch financial advisors, the three takeaways that I got from what you were just talking about, performance. So, this kind of goes two ways. One is I don't think short term, you want to be negative about performance if your investments didn't perform like the market did. Mm-hmm. On the flip end of the scale, I attend a lot of industry conferences, and I'll have booths that I'll walk up to, and somebody's promoting their short-term performance. So they might say, well, last year, we beat the market because we were only down 2% and the market was down 20%. And, sometimes they say, blind squirrels find a nut once in a while. And so when you're looking at performance, you want to look at things over the long term. I met with a gentleman, Jerry, and he had the same strategy for, 15 years. And when you looked at it, it was year after year after year after year after year after year that the manager continued to underperform. So at some point, performance does matter, but try to look at it on a 3 to 5 year basis. Mm-hmm. Number two, fees really do count. If you're starting the year off in the negative because you're paying all these fees and expenses, in this example, Jerry, he had one of those very expensive variable annuities that had no real benefit in his situation. You can eliminate a lot of those fees and expenses and go to lowest cost solutions, and that puts money right back into that client's pocket to be able to keep. And number three is optimization. So are you optimizing everything that's working in your portfolio? When we met with Jerry, one of the things that we noticed is a lot of his safer assets had not been upgraded into where some of the newer higher interest rates were. So he had money that could be working harder for him. And when you're thinking about a couple $100,000, 1%, 2%, 3% difference makes a big, big difference in what that investor gets to keep in their pocket. So happy to help out. And if you have that question on when is a good time to switch advisors, we're always happy to help you.
And it's as simple as picking up the phone and giving a call, 419-794-3030, or going to the website, arhq.com. Perhaps your philosophies no longer align, or your values, not saying politically or religiously, but, just are they accumulation-minded or are they retirement-minded? And what phase of life are you in? Obviously, Nolan, I'm sure you've given your son some advice there, but as far as he's concerned, being 19, he's got plenty of time. I don't think retirement is in his picture anytime soon, but for a lot of our listeners and viewers, if you were getting ready to make that transition, in the same way that you no longer see your pediatrician, I'm assuming, and I'm hoping for a number of reasons, honestly, but perhaps, seeking someone more specialized to where you are in life right now. The team at America's Retirement Headquarters is here for you, 419-794-3030, or the website, arhq.com.